You're listening to Real Estate for Real People, hosted by the Stone Sisters. The Stone Sisters have built an award-winning realty business, and they're here to share some of their knowledge with you. A new episode drops every Thursday. If you enjoy the show, please share it with a friend and leave a review wherever you listen to your podcasts. And visit www.stonesisters.com for more information just like this.
Awesome. Hi, welcome back to the podcast today, Real Estate for Real People. We are thrilled today. I'm not using the word excited. We are thrilled to have John Antle from johnantle.com. He is a mortgage specialist here in the Okanagan. You're licensed, I think, everywhere. So you're not really just tied to Kelowna, which is amazing. We're going to learn all about mortgages, what you're seeing, what the banks are doing, what your take is on the market and forecasting what you think is going to be coming. So yeah, maybe we can...
Yeah, tell us a bit. Why don't you start, John, with letting us know some of your experience and how long you've been doing this? And I know we've worked together for decades. But,
well, I've been in mortgages for a long time. No.
Yeah.
Well, I transitioned from being an investment advisor at Nesbitt in 2007. And then just in time for that crash to come into the real estate crash in 2008. It was perfect timing. And I've been in finance since 2008. Rolled out johnantle.com in 2010 and have been here ever since.
Wow.
Yeah.
Yeah, it's been pretty exciting.
Yeah. Well, I know that you have saved a lot of deals that we've done and, helped a lot of our clients and have always done excellent customer service. So thank you for that. Our clients have always been thrilled working with you.
And one thing, lots of people don't understand the difference between a mortgage broker and then just walking into RBC or Scotiabank. So why don't we start with that for those who don't really understand that there is a huge difference?
Sure. Yeah, that's actually a really good question because there's a substantial difference just between the educational requirements. So in order to work for the bank, anybody can get a bank job. There's no educational requirements. There's no knowledge requirement. Essentially, you're just brought on and you're trained in-house. And essentially, if you can data enter, you can do the job. To become a mortgage broker, you actually have to go through licensing and certification. And then you have to become a trade. It's a trades. You become a tradesman or a tradesperson or whatever it is. And you have to go through annual recertification and continuing education, things like that.
Wow, I didn't know that.
I didn't either.
Yeah. And well, the bank goes under the Bank Act, and then the mortgage brokers go under the provincial regulations.
Right.
So BC has some of the strictest in Canada as well. So when you deal with a mortgage broker in BC, they may ask you for additional information. There's additional forms that you have to provide because we have to declare how much money we earn, what the true rate of interest is, all those things that go along with that, where the banks aren't required really to do the same thing, even if a person's paid commission or whatever. So if a broker is charging you a higher interest rate, they have to declare it and they have to tell you if they're earning more money because of it.
Wow.
Or in the banks, they don't. They can...
Wow, interesting. Yeah. And then as far as products that you can offer versus like for a consumer going in and they look at working with, yourself, a broker or the bank, what's the benefit to the consumer of working with a broker?
Well, working with a broker, you're not hammering everything in that round hole, right? That post.
Yeah, right.
You're going to find the proper solution for each individual. Now, the banks are great. We offer the banks as well. I mean, they've got great products, but the benefit is you're going to have access to 60 or 70 additional lenders that you wouldn't have at the bank.
Well, isn't it true? I was always under the understanding that if before there were mortgage brokers, people would go in and check with 5 banks. And every time they did that, their credit was pulled 5 separate times in order to have, a comparison or have some different opinions. Now, if they come and see you and they've got access to 80 lenders, are you only pulling title or pulling their credit once?
Yeah, so that's actually a really good question because we do pull that bureau once. And that profile is saved on the credit bureau is saved on their profile for 30 days. So when we go and we shop with the multiple lenders, we reuse that same credit bureau for up to 30 days.
Right.
Now, lenders can ask for, an updated bureau or what have you, but it's really untypical that they do. And that enables us to go to multiple lenders without additional transactional hits on their credit rating, right? So that does add some additional benefits too. Plus, when they come to a broker, not only can they just get the A mortgages, but you can get the alternative mortgages. So let's say you don't declare enough income, there's those options as well.
If you're self-employed.
If you're self-employed.
Yeah.
Or, if you're somebody that needs some private funding for a period of time or what have you, just there's different alternatives there's different solutions for every alternative there. So.
Well, because that's the big thing that we've seen, of course, with interest rates rising, and we'll get into that in a minute. Maybe you can talk about today's rates, but it's, I think it's gotten a lot more difficult for people to qualify. So sometimes they do need some private money or.
Yeah.
You're like, Tamara, don't do that. I don't want to go down that path.
Well,
as I open it up.
Yeah, you're thinking, okay, let's jump into rates and what you're seeing today.
Sure.
Yeah.
Well, rates, that's a good one. So I get called on rates all the time, and people will go on to like RateSpire, all these different rate sites and look it up. And there's so many different rates to quote there. So usually everybody posts their insured rate. And the insured rate is going to be the cheapest rate because that's guaranteed by the insurer. So there's Sagan, CMHC, and Canada Guarantee. And what those do is they guarantee that if the lender goes into foreclosure, if the borrower goes into foreclosure, that the lender recoups all their costs.
Right.
So there's a real benefit to that. So they can price their money cheaper.
Now, there's a cost with that. So before we jump ahead,
Sure.
there is a cost to the borrower.
Yes.
On a mortgage. So,
and it's around 4%.
Wow.
So,
Oh, wow. Okay.
yeah. So if you're going high ratio, typically it's a 4% premium added on to the mortgage to cover that. Yeah. Yeah. But then there's there's insured, which is the cheapest rate that will be shown.
Yeah.
And then there's also a rate called insurable. And that is you can go conventional and you don't pay the high ratio fees, but you can get high ratio like pricing. But you have to follow the insurer's guidelines. And that's in the event that the lender can then, go and insure that mortgage if, you're going into financial problems, right?
Got you.
And then there's conventional, which is your 30-year amortization, 20% down. And then there's also pricing for refinances with certain lenders and rentals. So when you're looking for price, when you just call up and say, what's your best rate? Well, there's a whole bunch of variables that you have to take into consideration as well.
Right.
Right. And so what is the posted rate, I guess, if that's the question to ask? Or
Well, the 5 year is 5.45, but it's the 5-year rate that the lenders are offering.
Right.
So you can get a 5-year anywhere between 4.64 right now.
Yeah.
And 5.19, even higher.
Really?
So there's quite a variance through there.
It just depends.
Right.
And the same goes for variable too, right? So certain lenders will offer, a discount on variable, and that's based on the amortization period, 25 or 30 years,
Right.
whether it's insured, insurable, or conventional. And then some lenders do actually increase their prime for their variable rates as well. So you may think you're getting a better rate, but some lenders will charge a 15% premium on their prime rate.
Wow.
Yeah, so it's just,
You've
it's
really
knowing
got
what
to read the fine print.
you really need to know. And then
again, that's why you want to have a mortgage broker rather
right.
than, with all due respect, just going and speaking to the bank because they might not point out all those.
And if rates are the same across the platform, the product makes a difference as well.
Okay.
So some lenders have higher payout penalties than others.
Right.
The way that they calculate it, and it can really add up. So the average person has a mortgage for they live in their home for 3.8 years or whatever the stat is now.
Yeah.
So when you get a 5-year term, there's going to be a penalty to break it, even if you port it, depending upon the port.
Right.
How long it takes you to move into your new place. And that can have a significant impact on you as well. So finding out which lenders are going to allow you to port, finding out which lenders are going to have interest rate differential charges on it, how they calculate it. And then that can impact even when you take over your new place.
Right.
So because if there's that delay, you have to pay your penalty in your mortgage. They give it a rebate up to 90 days back. That no longer forms part of your down payment.
Right. Okay.
So that can really impact somebody's funds for their next purchase.
So next question, I guess, is, what are you seeing? What's your forecast for what's coming down the market?
Yeah, that's good. I mean, the forecast, you can look at the bond forecast, and they're expecting bonds to pricing to go up 20 basis points in December. And bonds directly correlated to what mortgage rates are. So if you want to trend where mortgage rates are going, you follow the trend on bond yields, because the banks will issue bonds to raise capital and things such as that. So, the banks are forecasting another 20 bips increase, and The Bank of Canada also has indicated that they're going to allow prime to keep going up until inflation comes back to 2.2%.
And what is inflation currently? Do you know that?
Geez, we're at 4 last month or whatever. So we're far ways away from 2.2%.
Wow. So do you think we're going to see double-digit interest rates again in Canada?
I sure hope not.
Me too. Yeah. But I know when I got into real estate 10,000 years ago, after the last dinosaur dropped down, then I came into real estate. But when I got in 1995, interest rates, I remember selling my best friend and her husband a house and got them to sign up with an interest rate for, I think it was 8 years, which seems like a strange term, but I feel, my memory recalls that was it. And it was at 9.7%. And mom and dad, who'd been in real estate for years during the 80s and those really high, 20% interest rates, they said, lock in. They should really lock in because it's single digit. And they locked in. And of course, we all wish they hadn't locked in because interest rates just proceeded to drop. For 20 years. So, I know that's a distant memory, but not that distant for a lot of people. And you wonder if interest rates now, if we're seeing 5.5%, then 7.5% is probably not that far a stretch, which means
it's not that far of a stretch.
9.5%, which
is really that very close to 10. But
I don't think so, but the demand on money doesn't appear to be there.
No, and if you look at the forecast, we're hearing rumors that we could see up to prime increase up to another 1.5%, but until that occurs, right? But that brings qualification rates up to like 9% plus as well.
That's right.
Because of the stress test.
Because of the stress test. So what the stress test is.
Yeah, I was going to say that's great to talk about because lots of our listeners won't know. They may have no idea and haven't embarked on this yet. So this is great. And
it's important because when people usually try and figure out what they can get on their own, and then they go to a lender, they're like, wait a minute, this doesn't make sense. So for the stress test, what the federal government came out with is to say either people have to qualify at the 5-year posted rate or the rate being offered plus 2%, whichever is greater.
Okay.
Okay.
So,
I didn't even know that.
Yeah. So for example, let's say you're just doing a traditional conventional purchase right now, TD, and their 5-year rate's 5.19. You have to qualify at 7.19%.
Right. Got you.
Yeah. 7.19 dramatically reduces your borrowing ability because it wasn't that long ago that people were qualifying at 4.79.
Right.
Right.
Wasn't long ago at all.
Wasn't long. It was March, this year, right? And that goes to affordability. And what we were talking about prior was, in March for a $1.3 million home with, $500,000 down payment, you're paying now over $1,800 a month for that same home.
Wow.
Interest today, same year, just a few months later.
Wow.
$1,800 a month more in interest cost. And you also your income required for that same home, you're going up almost $65,000 to qualify for that. Income. So, when you look at, sorry, I don't mean to go off on a tangent here, but when you look at people trying to time the market, they're like, well, I'm just going to wait for the market to flatten.
Yeah.
You're going to pay more for that house, in theory, because as interest rates go up and you say, okay, well, I'm going to save $200,000 because my house is now $200,000 less. Yeah. Right. But your interest rate now is like
have gone up
3-4% higher. Your overall borrowing costs over the term are going to outweigh your potential savings there. And your monthly cash flow is going to be dramatically impacted as well on that. Right. So that comes down. I don't know what you're seeing. Are people saying, well, we want to sit and wait and see what happens in the market?
Lots are. We're starting to see some people come back in. When we had the last interest rate hike on September 7th, I think that was. Yep. And we did start to see people coming in. I don't know if that's just people that were pre-qualified before that are now just trying to get into the market before those qualifications, are void. So it'll be interesting to see sort of what the next 2 months bring or the next 6 weeks, really.
Especially as a rate holds too, are starting to are going to start falling down, right? And then people are, if they have a rate hold now, that's good for 90, 120 days. They'll be able to qualify based on that rate hold plus 2%. But when that expires and the interest rates have gone up, substantially, it'll have a big impact on affordability.
Right.
And then just, what people can get. So I think that, myself personally, my own belief system is that I don't think people should really wait to make their purchase because it's going to cost more. It's just going to cost more. So
and
if it goes up to 9%. I think
it's something people don't really factor in. They look at the purchase price of the home.
Yeah.
But I don't know that they factor in all the borrowing costs and how it'll become less affordable.
Which is interesting because when you look at when you go to buy a vehicle, and so many people say, well, what's your lease? People don't talk about the sticker price of the vehicle anymore. People talk about the lease, which is the same as the mortgage.
Yeah.
So that's what people should be looking at if they're doing any mortgaging at all, putting a mortgage on.
Well, let's start listing houses. Just it will cost you
X amount.
$4,000 a month.
Honestly, though.
Not a bad
Not
idea.
a bad idea. Yeah. Jot that down.
Our competitors who are listening are like, yes, okay, I'm going to try that now.
But and for example, but for seeing the problems that people are going to come into with affordability, we now have lenders that have come out now with 40-year AMs again.
Wow. Okay,
Yeah.
I hadn't heard that. Interesting.
That's a 40-year amortization for those who didn't catch that or didn't
That's
know what
right.
that meant. But
So 40 years to pay off your
40
house.
years, but that's on the alternative side. But 40
Right.
years, I mean, it gets you out of potentially the rental market that doesn't exist here.
Yes.
Right.
And gets you in a home, and down the road as things change for you, you can definitely refinance that and go out of that lending
That's
scenario.
true.
But,
At least you're in.
but it gets you in, right?
Yeah.
But
Interesting.
So what do you think long term? Like I've read a lot of things that talk about, okay, when interest rates start to go up, when do we start to see the trends of those interest rates going back down again? When do we see inflation kind of get tied in? And some of the studies that I've read say about 12 to 14 months after interest rates start going up, normally that's when we start to see inflation sort of take its, their plan works and they start to see interest rates come back down again. What are your thoughts on that?
Oh, jeez.
I
That's
know it's a
loaded
crystal
question,
ball.
eh?
It is, and you have to have a crystal ball, but just your own John
Your gut
Antle opinion.
feeling.
Well, I mean, every period is 7 years, financial period on average, right? Is 7 years. And we've gone over that in the last run for a while there,
Yes.
right? So, are we going to have an equivalent pullback in the marketplace? Who knows? That's the magic 8-ball question. It really depends on how the federal governments, deal with the inflation problems that we have right now. I mean, we've got, a whole bunch of new tax increases coming in,
Yes.
not to go off on carbon
No, but it's
taxes
good.
and everything
Yeah.
else, but that increases the cost of goods, and that directly has a charge on inflation and the metrics that the governments follow to figure out, where we should be. So if they want to be at 2.2%, yet there's additional tax consequences coming into play and things like that.
Right.
It's going to have to reduce consumer spending quite a bit to bring it back down to 2.2. So traditionally, and would we say 12 to 18 months, to see, some improvement? Yeah, but we're kind of in different waters here too. And
Very much so. I agree.
Going forward, there's so many different variables here where I'd love to be able to tell you. I just don't know.
No one does. That's the whole key. Nobody knows.
And in the spring, we were talking to a lot of people about getting the 10-year mortgage rates and things like that. And people were, hedging, the risk there and have made out very well.
Yes.
With, sub 4% interest rates for 10 years. That's fantastic.
As long as you were going to stay in your home.
But, are we planning to see interest rates coming down in the next 2 years? I'd love to see it, but I don't think so.
No.
Overall, Canadian historical rates should be, in the mid 4s to 5s for mortgage rates anyway. So we're
kind of an average.
Kind of on average right now.
Makes sense, yeah.
And that's having a big impact on the market right now. So, if we have a rates that go up to, 7-8% again, which I don't think would be,
out of the norm
out of possibilities right now. And what that could to do to the average household, right?
Right.
So really what it comes down to is, going off on another tangent, there's just, getting people in appropriate homes, getting appropriate level of debt.
Yes.
And even though people have to qualify at a 2% higher interest rate, truly, are they prepared when it goes up 2%?
Well,
right?
and I think,
they really do it.
To avoid the disaster that you saw in the U.S. back in 2008 with so many foreclosures and so many people absolutely unable to pay and to qualify. I'm glad we've got these precautions in place. I think it's a good thing. As much as I know when they started talking about stress test and brought it in, we all thought, oh, this is going to decimate the market. But it's a smart thing actually that gives people a little protection. I mean, that's something we haven't talked about it yet, John, and I'd love to hear your point. But foreclosures.
I was going to say that too.
People are asking. I know I have a search set up on our Matrix system for foreclosures to watch them. And in March, there were 0 foreclosures listed in Central Okanagan or court-ordered sales, how it could look. And then in June, there were 3. And I just looked last week when I got back from holidays, and there were 11.
Wow.
So,
not a ton when you look at the overall market, really not compared to what people I think would assume there would be.
Yeah.
What are you seeing? Are you seeing?
I haven't seen any.
Interesting. Huh?
No. Yep. I have not seen any. So, lenders will send out foreclosure listings and things like that as kind of a, a way to build your business. You can send out those listings to realtors to try, but I have not seen any foreclosure listings come down the pipe.
Interesting. No, it's not something we've heard of. And even these 11, these are court ordered sales. So this could be a marital dispute. It could be.
Yeah, that's
Are those ever a good deal though?
No,
they're not.
Honestly, they're not at all.
Well, you move in and you have no appliances, like you have no warranty on the property. So you could have, the property could be in huge disarray and you have no idea what you're getting at the end.
Steal what's in it.
That's it.
Yeah. And you can buy, we've had a few people that have come to us over the last couple of years wanting to sell a home that they bought at court, they bought as a foreclosure. And when you buy it in foreclosure, it's, at court, it's as is, where is.
Yeah.
And they bought homes that were grow-ups. And they didn't know because the bank doesn't have to disclose anything.
Really?
And sometimes the bank doesn't even know.
It's on the city file.
I guess so, yeah.
It's a stigmatized property. That title, and they didn't know it was a foreclosure, and we got to be the bearer of the great news and go, okay, well, your house is worth 15% less, 20% less. Let's talk about that for a minute. How hard is it to finance an ex-grow-up?
Oh, it's horrible.
I know that because when these people wanted to list the house, and I'm like, John, what do you think? And
well, there's no federal standard, and that's the requirement because each municipality has, remediation requirements, right?
Yeah.
And nobody's got together and create a federal standard until that point in time. The big banks don't want to lend on those things.
Right.
Because each municipality can dictate what a grow up, needs to have to be remediated or if any, if some municipalities don't even bother with that, I'm unsure with that, but right now we're only seeing the credit unions are the one that will do it.
Okay.
But what happens though, as part of their portfolio business, they can shift at any point in time to not want to take any more grow-ups on. And truly, why would they want to?
Yeah.
Right? When it's days on market, they're looking at for sales of property. A grow-up traditionally stays on market longer, right?
Sure.
So when they're taking a look at their book of business and planning their financial model, there's even that risk to the buyers. They say, okay, they think they're fine with having their mortgage there, XYZ institution, but just, I've never heard of a company not renewing. But say, the market gets super tight and money is they don't have a lot to lend out.
That's right.
It's well within their purview to say, you know what, we're just not.
We're not doing any more. Or perhaps the threat of we're calling the loan. We want our money back now.
We're not renewing it, right? So that's something to be cautious of. Because I've tried to talk to clients when they buy grow-ups. I'm like, just, it's not necessarily, you're paying a higher interest rate usually, up to 1% higher or more in some instances.
Yep.
So when you look at the discount you get versus the premium you pay for 25, 30 years, one offsets the other one clearly. It just, you're not, it's the same as a foreclosure.
Well, and it's such an unknown.
Not the same. It's not the same as foreclosure. It's just
but it's the unknown.
Yeah,
Anytime that there's an unknown, why go that way when you can have a safe avenue? It just doesn't make sense.
Yeah.
So I have
you're
another.
not getting a discount on
No,
grow-ups.
you're not at all.
Yeah.
I have another question. So here in Kelowna, average house price is hovering now just under 1.1. Or, I think it's closer to $1 million. What are you seeing as the average mortgage that you're dealing with? Would you say?
Well, my average mortgage is in the 8s.
Yeah.
So it's, fairly high.
What's the biggest mortgage you've ever done?
Now we're getting into like the secret stuff.
I want to know.
Jeez.
You see some of these sales go through. I see $2, $3, $5 million sales. Are those people paying all cash? Are they?
Those are hard to get mortgages for. So it's not hard to, but you're not getting a $5 million mortgage, right?
No.
So when you're buying a $5 million property, you have to have a significant down payment for that.
Right.
Because the lender doesn't want to, it's a unique property for one, and the percentage of buyers in Canada is really reduced.
Yeah.
So when, I've got to be careful on what I say for value wise because there's certain homes that have certain values that,
Yes.
But the lenders, I've had financing actually pulled back from a lender just when COVID occurred because they said the home was worth far too much and it was only international buyers. So they just turn it around. So if they had to foreclose on it, they're like, no, this will be international buyers only can afford this house.
Wow.
We're choosing not to. I mean, I found lending elsewhere, but
that's so interesting that they look at it that in depth or look at it from that perspective. It's not, okay, we have X amount of equity built in. It's like, no, that doesn't matter. It's how can we sell this?
And that's actually a good statement because I think majority of people think that when they're purchasing a home, they're like, listen, I'm putting 50% down on this property. Why is it such a hard time to get financing for? Well, the banks, they look at days on market on average for communities, and that's how they dictate how much they will lend in certain areas as well, right? So, like for example, Joe Rich was always difficult to get financing in.
Okay.
For a period of time because their average days on market was 300 and some odd days on market.
Right.
So when a bank goes into foreclosure on that property, they're looking how long is it going to take us to recoup our losses. They don't want to sit on a property for a year. And when you look at these multi-million-dollar properties, how long do they have to hold them for? Like,
makes sense.
How many buyers are out there in the world for, $5-6 million property in the Okanagan? Well, quite a lot, right? Because
right now,
that's a ton of properties like that here. But, and that's something that you have to look at, right?
Interesting.
Yeah, and I get that question all the time because a lot of people trying to buy, large acreage properties and they're like, how does it make sense? All these people own these houses. How did they get them? Well, they put a lot down.
Yes.
And they have substantially strong books, right? That's really what it comes down to.
Right.
Because cash flow is king, but they also want to see fallback positions. They want to, even if you put 50% down on it, they're going to want to see that you have
the means
that if something goes wrong, that you can continue to pay for that. Because the people that purchase those are typically in different occupations or scenarios as well, right? So,
Yeah, self-employed. So that's something, if somebody's looking, what can they do? Self-employed is
I was just going to say, I think that's a perfect way to sort of wind it up is what are some things people can do ahead of buying a home? Like before getting qualified, you know that in the next year you want to buy a house. What should you do today?
Well, you need to plan. And that's...
Yeah.
Was that kind of your question?
Yeah. No, it was, and I was looking more at self-employed, but really it works for anyone.
For anyone, right? Because especially now, because the last couple of years back, it's been pretty static in the finance world, right? Interest rates have been really low. Getting qualified has been money's been abundant. It's been super easy. Lenders are just throwing it out. And, and then if you were to go and reapply at the same lender 6 months later, you're like, wait a minute, what's going on? Why are you asking me so many questions? Yeah. Why is there a constant paper being requested, right? So people need to plan. They need to truly, it's not just getting pre-approved, but get pre-approved, do a great budget, find out, exactly where you're at, get a fallback position in place as well, because lenders are looking at that more and more. You can't use 100% of your savings to purchase your house. They want to see that you have the ability, if something goes wrong, that you can actually continue with the mortgage.
And what does that mean?
Right?
What is a fallback position? How does somebody, let's assume our listener is 32 years old and they have $40,000 saved and are hoping to buy a townhome in the next year. So, what would a fallback position be?
So in the Okanagan, that person would be a high ratio purchase.
Right. Okay.
So that's a little bit different because it's 100% guaranteed by the insurers. And they're required to have not only the minimum purchase amount plus the 1.5% of the purchase price to cover additional costs as well. But mainly this is when we're talking conventional buyers.
Okay.
And if you're using 100% of your income, depending upon the cost of the house and things such as that as well, right? 100% of your savings to make the purchase. Now some lenders are even asking for the 1.5% as well on top of that.
Yeah, for conventional.
For conventional. Now, if the ratios are tight, meaning you can just afford that home with the qualifying rate, we've even seen lenders pull back and say, listen, you know what? There's no fallback position. It's right at the max of your affordability, but you don't have any additional savings. If something else happens, what are you going to do? So that's where it comes into planning to, set the expectations appropriately, for the housing, right? Make sure you have the appropriate amount of savings and make sure that you're prepared as well for that monthly payment of $3,500, $4,000, $2,500 a month, whatever it is.
Wow.
Because, a lot of people, when they're coming from the rentals, rent here is pretty cheap. Pretty expensive, not cheap.
Yes, yeah, it is. It's really expensive.
Yeah.
So you can move from a rental into a home and it's pretty consistent.
Yes.
But a lot of areas it's not. So if you're coming from outside the Okanagan, and you're moving here, buying even a townhome, but you're used to paying $1,300 a month, now you're going to be at $2,400 a month.
Right.
Set up a savings plan that takes the equivalent out of your monthly budget, so that and take, if you're going to strata and that's where you're going, take another $500 a month out for strata fees and a few others into a forced savings plan, and just ensure that if there are any variables with interest rates, which there will be, because there always is, that you can afford that property for the long term, so that you're not part of the 11 foreclosures.
How much influence for somebody getting a mortgage, a conventional mortgage, is the employer, for how long they've been, employed at the certain company, or somebody forecasting? We've done that a few times, of written letters for, you've been employed here. We foresee you being employed here for, forever. And so how much do they look at that sort of stuff?
Oh, they look at it.
Yeah.
So and that's a good question, because when it comes time, a lot of people are like, well, I've only been at my job for 3 months. Well, that's fine. That's fine. 3 months. And it depends on your age, what you were doing prior.
Right.
So if you just got out of university, you've been an employer for 3 months, and you have enough savings and everything else, usually you should be fine. Right. If you were in a sales role and then went over into a salary role in a different occupation, lenders could take a look at that and go, well, wait a minute here. This is, if it's completely change in employment,
right,
we might want to see you there a little bit longer before we give you some funds, right?
Yeah.
And it's their right. It's
For sure, absolutely. It's their money.
It's their money, right?
That's right.
And that's the...
Well, and I think something else, that we've known, people probably, in anticipation of buying, get a credit check done on yourself. I know you've helped us, John, where we've had people who didn't pay a cable bill 10 years ago, and that's still showing up on their credit rating, or an
consolidating
unpaid,
some of those things. So
Costco
instead of having
credit card,
That's
or
right.
a really expensive lease payment on a car.
Or a phone bill. Phone bills are the worst for hurting people's credit.
Really?
Interesting.
Yes. If you look, whenever you look at somebody's credit bureau, it's usually, one of the not TELUS, not singling anybody out. It's usually one of the cell phone providers. And
Really?
Yeah. And they hit people more than you can believe.
Crazy.
Or if you had an ambulance call and somebody called an ambulance for you.
Yeah.
And you didn't pay it. You forgot to pay it. Or if you moved and let's say you had a Rogers TV box.
Right.
And you moved and you're like, well, you drop it off and it doesn't get recorded, whatever. I've seen this tons. And there's a collection that was originally for $114 and it sat, and nobody's contacted you.
Wow.
But it sat on your bureau for 4 years. Now it's worth $800. Oh. The lenders, when they see that as well, they want to make sure that you satisfied that collection in 100%. So if you can go and you make a deal with them and say, listen, I'll give you 50%, they don't necessarily like that, because now not only did you, not only are you behind in your payments and allowed it to occur, and now you tried and settled with them, you paid less when in fact you didn't make them whole for what you truly owe them, right?
Now you can, have I got this right, that every Canadian citizen can pull an Equifax, have I got that right? Report on themselves once a year?
Yeah, for free? Yeah, but it doesn't come with your score. No.
Okay.
No. Okay. And this is a good question as well. Thanks for bringing that up. So most financial institutions now as well offer free credit scores with banking apps and things like that. And I'll have people that bring their score in and say, hey, why is my score so different between yours and my score they pulled? Well, there's different, they call them beacons.
Right.
So when you go and buy a car, they're using a different credit score tool from Equifax. That's why you can say, well, listen, I just got a car, no problem. What's the problem with getting the mortgage?
Okay.
So we look at it slightly different. So not only could your score be different on Equifax, and it can be substantially different what we've seen. But getting your Equifax, and get Equifax, just everybody get Equifax, forget TransUnion. Because the majority of lenders use Equifax. Only truly right now, RBC is the only one that uses TransUnion, but they're doing a dual
So
poll
Equifax, you can Google it, you can find it online and fill in your information. Once a year, it's free. And at least see if you didn't pay your FIDO bill.
Exactly.
Remind me as soon as we're
John
done.
Antle and he'll pull it for you, right?
Well, but we can't share your bureau.
Right, okay.
So we can share the results of it, but we can't give you a copy of it.
Oh, okay. So you have to do that
So you
yourself.
have to go to Equifax yourself and get that. So we're not allowed to release that information. It's the same as the appraisals because everybody's like, hey, where's my appraisal?
Yeah.
I paid for it. We're not allowed to release that to them because the lenders own it.
Right.
So it comes down to Equifax as well. We sign an agreement with them when you get the rights to pull credit bureaus that you can't share them, but we can share the results of it, right?
Right.
But that's very key. So I say pay the money, get on a credit monitoring system. You know, was it $14 a month, whatever?
Yeah.
People spend $14 a month on Starbucks. Go get your credit score
for sure.
done. Even if it's $20, get it, stay on there, monitor it, build a plan, you know, forecast where you want to be because it's a house. I feel people spend less time talking about finance with me on a house than they do buying a car, right?
Oh, I would agree.
So
yeah, it's true.
Put the time in and create a good plan. Focus on where you want to be and just don't rush into it so that you're not put in a bad situation, right? And then pick the right lender.
Wow.
Rates are great, but product matters more.
Wow,
Great
John,
advice.
what valuable,
Great advice.
valuable advice.
So
this was great.
I have one last question, and then we will let you go. Thank you so much. This has been amazing. But looking at it, when should people come and contact you? How soon before they're ready to buy? Is there a time frame
That's
that
a
you
good
like people to
question.
reach out to you?
You know, I've worked with people up to 3 years in advance of buying, just putting together plans and goals and things like that. I mean, that's on the extreme end, of course, right?
Yeah.
But I would suggest minimum three months before you're maybe to go in, especially to set a rate hold as well and things like that. But come in, we'll create a plan for you, ensure that it fits with your financial situation, and I would say minimum 3 months, and before you list your home. You know, because
absolutely.
if you're thinking of selling, go see a broker right away, see what you can afford, because there's nothing worse than thinking that you're going to be able to sell your home, move up into something better, and in fact, it could be the opposite.
Yes.
So you want to plan for success, not, leave it up for failure, right?
Wow.
Great advice. Thank
That
you
was
so
phenomenal.
much.
Thank you. Really interesting.
Any
That
other
was something
comments
we should have
you
been
have?
excited for.
Yeah, I should have. You're right.
Any other
comments that you have?
For sure. I can be reached Monday to Friday.
Awesome. That's great. So where can people reach you? How do they reach you? Where are you?
Awesome. So I focus mainly online.
Yeah.
So they can go to johnantle.com. That's my website. There's a contact me page there, as well as there's an apply now. So if somebody's just interested in getting their pre-approval done immediately, you can fill out our online application right there. And we can send out links where you can automatically load your information into our servers, so it's all safe and secure. And then we can come back with, response and let you know exactly where you're at, right?
Wow. So that's John, JohnAntle.
.com or 250-212-8512. You can call, text.
We will put all those details down below in the comments. So, John, thank you so much.
Thank you.
Really fascinating. Thank you so much.
Thanks for listening to this episode of Real Estate for Real People. If you want to reach out to the Stone Sisters, visit www.stonesisters.com. This podcast was produced by Podigy Podcasts. See you next time.